Here comes a big week for the financial markets because this is the week that Trump becomes officially the president of the United States. How is the dollar going to react, guys? Ken Chigbo back with another EA's market fundamental update. This one's juicy. Let's jump straight into this. So starting off with the US dollar, as I just mentioned, we do have the inauguration of Trump, where a lot of volatility, of course, is expected because we've had this massive pumping in the markets. The dollar really benefiting from the official Trump trade, okay, where we're expecting his policies to be very much bullish for the dollar, bullish for the United States economy. It's going to be potentially negative for some of the US peers because of these tariffs for the likes of China, Canada, for Mexico, potentially for the Eurozone. All right, and we're expecting them to be very much inflationary in terms of these policies, pro-growth, which is why potentially the FOMC are going to be more hawkish for this year of 2025. So all has been supportive of the dollar. Now, if you take a look here, actually, before we take a look at the chart, in terms of, obviously, we've seen this Trump trade, the pumping to the upside in anticipation of these Trump policies. But it's important to note, obviously, where we've seen one directional moves, and obviously people have been buying on this anticipation of Trump inauguration and becoming president. There is obviously that potential that we have that volatility where we get, obviously, Trump comes into play, we get a little bit of a correction for the dollar. So buying on anticipation, selling on the fact is possible. But given how strong the macros are for the dollar, if we do get any potential pullback, I see it as limited. If you look here at the dollar, as I said to you guys last week, right? This is a big supply area here at 110. And obviously we've run into that supply area, a little bit of friction face, as you saw here back in September, August 2022. But overall, when you look at the trend and the structure, we've been supported to the upside, okay? Higher highs, higher lows, all of that good stuff. And obviously every period of consolidation, we buy, consolidate, buy, pull back, buy. We formed a potential bull flag here. Now, the reason why we sold off last week was just markets looking for an excuse. Slightly softer PMIs, all right? And we had a softer CPI, but that's just on the month on month. Remember, we need to look on the annualized to get a bigger picture of how inflation is moving. And on the annualized, it remains sticky, 2.9%. But markets don't care about that. They just wanted to grab whatever they could, look for an excuse for a dollar correction. And that's all it is, really. Retail sales, neither here or there. Had a revised higher on the previous number. Still in a good place, generally speaking. All focus, as I say, is really on this inauguration. This week as well, we've got unemployment claims, which are still in a good place in the United States. Claims are low. Labour market is still resilient and tight. We've got the PMIs as well. The key one being the services. Of course, manufacturing is important as well, but US is primarily a service-based economy. So be keeping an eye on that. I know Trump obviously does want to bring more manufacturing into the United States. So for me, for the dollar, I do see downside being capped. But I would like to see this continue to push the upside, effectively potentially breaking out of this flag and continue to go and challenge this 110 area. Maybe we can take a pop in towards 110.50. As I say, it does depend on the way the markets want to run with this volatility of the Trump inauguration. But I still, as I say, over the sort of the longer term, I do remain a strong dollar bull. The Canadian dollar is in focus because we do have CPI data. Why is CPI data important for Canada? Well, it's important because the Bank of Canada right now remains dovish. They've been cutting rates back to back. They've left the door open still to more cuts. Obviously, there's a lot of sensitivity around the Canadian economy. We had the uncertainty with the Justin Trudeau, the Prime Minister, stepping down. We've got the uncertainty of the potential tariffs from Trump. So Canada is vulnerable, all right? And especially if we see these cooler CPIs, well, on the month-on-month, they've generally been cooling. On the year-on-year, they remained a little bit sticky, but given this recent decline in the month-on-month, I'd like to see that filtering through to the annualized and seeing this coming, cooling to the downside as well. If we take a look here at dollar CAD, all right, dollar CAD, as I've said, I've been a massive dollar bull, right? And I've been obviously looking at this breaking to the upside, and we are effectively breaking out this bull flag now, breaking down this psychological 44.50 area. Watch for this breakout and retest, and I think it will leave the door open for a nice run in towards that mid 46 region. Obviously, that'll be supported by potentially if the dollar bulls continue to the upside, and if we get this softer CPI data, and of course, retail sales here expected to cool as well. If you look on the core and obviously on the month-to-month as well, which would support this bull flag breaking out to the upside and going challenging those 2020 highs. And also this is the 2016 high area as well. But that bull flag looking nice and potentially opportunistic for a nice breakout. Some focus on the pound. As we know, GBP has been under some heavy selling pressure with a lot of mess and concerns around the government finances. And obviously the UK being in that situation where growth is low. We saw a lower reading on the GDP recently. Inflation's still a little bit sticky. It's been cooling, but we've got a situation somewhat of stagflation in the UK as well. So GBP remains vulnerable. This week, we've got labour market data. All right. These numbers, I think, are quite kind, quite generous. Expected pickup in the average earnings, 5.6%. Unemployment rate expected to remain steady at 4.3%. Obviously, a couple of months ago, we had a big jump up from 4% to 4.3%. And claimant count expected more claims, unemployment claims this time round. For me, I'd like to see disappointing numbers in fitting with the narrative at the moment, with that feeding into that slowdown of the UK economy. With GU, obviously, it's a southbound train at the moment. You can see structure very much to the downside. We recently sort of started to break out of a bit of a flag, a bit of a rising wedge here, which I'd like to see a continuation of. Obviously, we need to see how the price deals with that psychological 121 towards 120.50 area, that 50 pip range there. If we break that down, it will leave the door open towards 119. And if we do get softer labour market data this week as well, it will further feed into the narrative and ramp up market expectations of rate cuts from the Bank of England, more dovish action from them. JPY, this is a big one because we do have the Bank of Japan rate decision where 80% priced in expected market expectations that they're going to hike finally again by 25 basis points, taking the rate from 0.25 up towards 0.5%. Now, UIDA, the governor and the deputy governor have both been trying to largely hint to the markets that a rate hike is coming, that the Japanese economy is in a place where it can, personal consumption still there, wages still at a decent level to keep inflation at around the Bank of Japan's target because they don't want that slipping below if they go and raise rates. There is a concern for me that maybe they were sort of verbally intervening because obviously the yen had been smashed with in recent weeks, and maybe they're like, look, rate hikes coming, trying to stop that yen weakness. Because the Bank of Japan have been known historically for moving very slow, like a tortoise. So I wouldn't be surprised if they disappoint the markets. Obviously, they need to be prepared because if they do disappoint the markets, that heavy yen selling pressure will carry on again. If we just look at dollar yen as a base case here, you can see obviously the pressure to the upside, remember, obviously because of the stronger dollar, has slowed down a little bit here. Obviously, albeit structure is still pretty much to the north, but we have formed a bit of a potential, what could be viewed as an evening star, validated by that bearish closure below, leaving the door to potential further downside. But saying that, obviously it does depend on the dollar strength. And we do have this trend line which has been in play there since back in September, which we could go and tap, and the dips could be bought, especially, as I say, if the Bank of Japan do disappoint. So keep an eye out for that potential risk. I wouldn't be surprised, in my view, I would not be surprised if they do disappoint and leave the door open for a rate hike at the next decision, okay? And this could just be a case of them verbally intervening for the time being, because as I say, historically, they do move quite slowly. But let's see. If they do hike, I still think there's room for yen to strengthen. But if they hike, and it's a dovish hike in the sense of they say, we're not going to rush for the next rate hike, then obviously yen is going to sell off anyway, because this rate hike is more or less priced in 80%. Is quite high. Euro, some volatility here because we do have the key PMIs, manufacturing and services PMI data from the Eurozone, which, the data from the last year or so hasn't been great. The Eurozone is in a situation where we've got high public debt levels. They've still got sticky inflation, right? Prices still high, but the consumer's suffering with these, the generally slowing down of the economy. These PMIs would only feed into that narrative if they do come out softer, which, again, I wouldn't be surprised if they do. They've been on a trend to the downside in terms of the numbers, especially when you look at Germany and France, the two heavyweights within the Eurozone, the two largest economies in the Eurozone. The numbers are still really, generally speaking, below that psychological 50 mark. Remember, anything below 50 is contraction, anything above is expansion. And obviously the key manufacturing is quite big in the Eurozone as well. All the European cars is really slow. Now, obviously, we've been saying this. Guys, I've been calling these shorts for a while now. You know that. Go and check all these recent weeks' videos for euro dollar. And it's still a southbound trend. Despite this weekly closure in the green, obviously that's just on the dollar consolidation and pullback. But when you look at this, lower highs, lower lows, all of that good stuff, and I'd like to see it playing out towards parity. Okay, I really would. I'm still keen to try and break down this 102 area where we staged a bit of a rebound there at mid-Jan. Maybe we can get a nice little breakout and retest 102 and open up the doors to parity. Okay, this is just my opinion. I still see massive divergence between the Eurozone and the US, and I'd like to see those flows continue to favor dollar over euro. Again, as I always say, this is not financial advice, it's my opinion. But yeah, keep an eye on those PMIs. Last but not least, NZD. Key inflation data from New Zealand. This is important because the RBNZ, one of the dovish central banks at the moment, they've been cutting back to back, and it's expected that they're going to cut again in February by 50 basis points. Inflation has actually been slowing down in New Zealand. If you look here, it's expected to cool again on a quarter down from 0.6 to 0.5. And you can see the general decline there. One of the reasons the RBNZ are dovish right now, generally seeing a slowdown in the economy. There's risks, obviously, to the downside because of the Chinese slowdown. Obviously, China is stepping up efforts with stimulus, but I still see New Zealand as vulnerable, being one of those vulnerable economies and also currencies directly to its own economy, but then obviously indirectly from China, its biggest two-way trading partner. There's a lot of consolidation going on right now with NZD. I'd like to see it ultimately just breaking out of this range, eventually breaking down this 55 area. Okay, here you can see, and then leaving the draw for a nice drop, you know, potentially down towards that big psychological 50, which is the pandemic lows, I believe. Actually, no, it's not the pandemic lows. It's the lowest levels that we saw in sort of 2009. So I'd like to see that eventually coming into play. So guys, once again, a week filled with volatility, blessed or not blessed, depends how you want to look at it, depends what political side you're on. But either way, we're expecting some fireworks with Trump coming into play. Other than that, have an amazing and blessed week, and I'll catch you on the next video.